Hello and welcome to Market News.
Well, we're in conversation with Navneet Munot, Chief Investment Officer at SBI Mutual Funds. Navneet, it's great to have you on the show today. And we're speaking at a time where volatility has become the order of the day. We've seen huge fund outflows from the bond market. People are worried about the equity markets. Yet, having said all that, we're so close to 6,000. What's going on?
So, of course, the market is showing tremendous resilience over the last couple of days. If you look at last couple of weeks and the flow of negative news, right from the Bernanke talking about the tapering off of the quantitative easing, look at the index of industrial production coming at -2%, Rupee at an all-time low. Look at, several negative news. In fact, and on top of that, the tightening by the RBI, and this is massive. The short-term rates have moved up by 200 basis points at a time when corporate India wanted a rate cut. So it's a hugely negative news, from that perspective. But market seems to be somehow digesting all this. So it shows that inherently there is bullishness somewhere. Two reasons. One is for the global investors. Our view has been that relatively India looks better within the emerging market space. So whatever money is there in terms of flows, I think India would continue to get that flow. And at a lower level, there seems to be some appetite for equity from the domestic investors. So in the month of June, we saw mutual funds having positive flows from the domestic investors. I think if the market falls, I think there are a lot of people who have been waiting on the sidelines. So it seems that market somewhere, has got some good amount of resilience, in fact.
So you feel that a floor is in place. Where is that floor then? That would be a reassuring sign. 5,700, 5,800 on the Nifty?
Yeah, so it's if you look at the Nifty, in fact, so there are two parts of Nifty. On one side, you have stocks in the consumer space, in IT, in some of the private sector banks. They are at an all-time high and a completely different kind of valuation. On another side, you have stocks which have actually fallen in last time in YTD, or if you look at last 1 year or last 3 years, and they are at a record low both in terms of absolute price and valuation. So market is quite, I would say, it's hugely skewed in terms of the performance. On one side, you have I would say an overvaluation, and on another side you have a lot of value that one can find.
Some of that overvaluation, particularly in banks, has come under huge scrutiny last 2-3 days. Since this move came in from the RBI, we've seen continuous fall in large cap bank stocks. Is there a re-rating or a sort of a downward rating of the entire sector that's taking place, or is it just temporary profit booking?
I think it's more the initial reaction to the RBI's news. In fact, nobody knows how long that is going to continue. If history is any guide, these kind of measures which any central bank takes to support the currency of increasing interest rates, they don't last too long. Hopefully over the next couple of days or couple of months, things should settle down. Of course, it will also depend on the global environment, what happens in other markets and how they impact our capital flows. But hopefully, in the next couple of days, if the dust settles, then and the short-term rates actually fall, in that case we might see some improvement in banks. Also, you have to keep in mind that the way borrowing rates can go up because of this move, the short-term, the short-term CDs are trading close to 10%. So if banks have to borrow money at that level in an economy which is slowing down so dramatically, where will you find good quality borrowers at that rate? So incremental marginal rate of borrowing has gone up substantially, which will put pressure on margins. And also the stressed part of the of your balance sheet can't afford these kind of interest rates, so you are actually increasing the stress even more on corporate India.
So Navneet, isn't the market then ignoring some very hard facts and some of the points that you just mentioned there? Because while these might be temporary measures just to shore up the rupee, the fact is that the central bank right now can't afford a loose monetary stance. So what happens to all these expectations of rate cuts and propping up growth and better second half? So isn't the market ignoring some very hard, disturbing facts here?
But actually this makes me a little more bullish on bonds for longer period, over a longer time, because by taking these kind of measures, actually you are accentuating the growth slowdown. You are basically putting more pressure on the growth. By taking these measures, you are also hastening the process of tackling current account and the inflation, because if there is a bigger slowdown, then your current account would be lower, and also the inflation, the pricing power for the corporates would be even more limited. So then some of these macro problems may get solved. In macro, there is a huge puzzle, how you look at it. I think longer term, again, I'll repeat the same point that within the emerging market space, relative to the problems that China has got and which is impacting most of the other commodity producers like Brazil, Russia, South Africa, and some of the other markets like Canada, Australia, New Zealand, India looks relatively attractive because at the margin macro is likely to improve. You can't have a sustained period of minus 2% IIP growth. I mean, at some point in time, sheer base effect, you'll start seeing better numbers. At some point in time, the investment cycle should reverse. Also, given the crisis, we have seen the measures that the government has taken on FDI. And I can expect that if the pressure continues on rupee, because that's when the government acts, I would say, in a more nimble manner.
Push to the wall, really.
Yeah, I mean, but world over, reforms only happen when the push comes to shove. I mean, and that is precisely that happened 2 days back, and then hopefully, and in the next couple of days, it should be followed with some more measures.
So you're talking about hopefully the macros improving. In that case, I want to understand what you're doing with cyclical stocks. We also had the first sign of real positive news coming in for power in the form of these fuel supply agreements, which have finally been signed between Coal India and NTPC. Is this the time to buy power stocks or economy stocks?
Yes, overall cyclicals, instead of going into individual sectors, and within the cyclicals, if you look at maybe some of the asset owners, the way currency is depreciated, the way overall cost of producing, I mean cost of putting up any infrastructure that has gone up. Also, if you look at the way getting all the clearances in place, whether it's environment, whether it's forest, whether acquiring land, all are going to be increasingly more challenging. In that situation, anybody who's put up a quality asset, I think is going to be more valuable as and when you see some recovery in the economy and you see a slightly better policy environment, number one. So you bought some quality asset owners, they may have some stress today, but I think those who have relatively stronger balance sheet within the overall space, we are looking at them.
But are these equipment companies, are these generating companies, are they from the roads or port space broadly?
Yeah, different, I mean a mix of all that you mentioned, but those who've got quality assets on the ground and balance sheets are in a position where they won't be in such stress that some of these assets have to get sold at a substantially lower level. So wherever we think that the balance sheet can survive for a couple of years, I think those assets are going to be very valuable. And the other part, the quality cyclicals. So I think at some point in time the investment cycle is going to turn, and lots of cyclicals within that. I mean, you can talk about whether the equipment manufacturers or some of the other stuff. At some point in time, a turn will come, and at least start buying the quality companies, those who don't have too much stress on the balance sheet.
Where does this leave the original favorite area of the market, which is consumption? Because we've seen last quarter this big debate about whether volumes are tapering off and what's happening, but then there comes a day when lever is touching 700, beg your pardon. So what's really happening with the consumption story? Would you still be willing to hold these stocks?
So the whole market, if you look at the macro environment globally as well as locally, of course in that people are looking for defensives, and within that defensives the whole investment universe has shrunk quite a bit. You want to buy predictability, I mean you want to buy a very strong balance sheet where there are strong cash flows, the great franchise and so on and so forth. And within that there are few plays within the consumer space, few plays within the pharma space, and few plays maybe IT and some of the other companies. But the whole investment universe has really shrunk over the last couple of years, and it's becoming actually smaller and smaller, unfortunately, given the whole macro environment, the policy environment. And now with these kind of measures like increasing interest rates, I mean it becomes even more challenging for fund managers. But having said that, I mean that space, because the entire money is chasing those companies, I mean several of them have become overvalued. But something which is trading at 35 times may trade at 40 times also. It's not first time in history, we have seen it several times. So this movie has got played before. In 2000, people used to tell me, I mean, one company is trading at 100 times, the another one is cheaper at 60 times, and you keep looking at relative valuations and keep justifying it. We have seen the same in the infrastructure space in 2006-07, industrial space, and maybe it could be true for some of the companies and in consumer space this time. But there are other niche players and other, so we are playing through maybe some plays in media, some plays in auto ancillaries, some plays and some of the other discretionary spending where we think that the valuation is more reasonable.
So will the market surprise us in the second half, you think? Can it really move substantially beyond where it is right now?
Yeah, so it will depend. One of the big event that could be is the election. In case after the state elections, for any reason, if elections get preponed, then of course we'll have that window of volatility. But I mean, depending on how the wind moves in the next couple of months, in terms of, I mean, who the market expects in terms of the forming the next government, can have a substantial impact on the market. Barring that, I think it would more or less move, I think, in a very narrow range.
And what about the currency? Do you think we've seen the worst of this rupee crisis? Are the worst of the days behind us?
The very near term is always very difficult to predict, but I think more or less the worst is behind us. I think even in terms of the real effective exchange rate, I think we have moved from an overvalued zone to an undervalued zone now. If I compare our currency with, let's say, Chinese currency, I mean, in 2007, I think it was a little over 5 RMB rupee, and today probably we are very close to 10. There's a substantial depreciation that has happened. I think it should give us some competitiveness, should boost the import substitution. Given the slowdown in the economy, I think overall imports should fall. The imports of gold should also fall, I mean, given the several government measures and then the slowdown. And I think exports should start picking up at some point in time, as we are gaining the competitiveness back in India for several reasons. And then hopefully over a period of time, the current account should fall. So I'm quite positive on the current account side.
Okay, finally then, Navneet, what is your sense on inflows into mutual funds, and also what would the advice be right now to the average retail investor? Stick to blue chip funds or diversified, or I mean, should you even play the high risk sector fund game right now? How does it look?
People have completely ignored equity funds, so forget about within equity funds what to buy. It's not that there is a lot of money and then they are kind of choosing. First come to equity. People have become extremely underweight equity and have completely ignored this asset class. Obviously in last 5 or 6 years have not been great for investing into equity, because the experience of people who entered, and large number of people entered in 2006-07 at the fag end of the last rally, they didn't have the great experience, and in last few years some of the other asset classes have done pretty well, like gold and real estate. But my sense is that if you take a next 5-year view, equity should be one of the best performing asset class, and people should start allocating decent amount of money to equity. Even the bonds are looking quite attractive because the yields have gone up in last 2-3 days.
Okay, so maybe it's time to come back to equities, says Navneet Munot. All right, great talking to you, Navneet. Thank you for taking out the time today. On that note, we'll take a very quick break. More views on the other side. Do stay with us.